Hello, and thank you for joining us on the Cornerstone Asset Management Services Quarterly Spotlight. My name is Stephanie Anastasakis. I'm the Director of Marketing here at Cornerstone, and I'll be the moderator for today's Quarterly Spotlight on why market research and history matters and insight into portfolio selection. Today we're discussing our research as well as current market conditions and insight into how that affects our portfolios. Just a few housekeeping items. We are recording this webinar for playback capabilities. With regard to the flow of this session, we anticipate 30 minutes total, and the schedule for today is a short introduction, our main topic discussion, followed by opening up the floor to questions. Another note, all callers will be muted and will remain muted for the duration. If you have any questions, please hold them until the end or use the chat feature, and we will try to answer those at the Q&A session. Additionally, for chart viewing purposes, we suggest adjusting your screen to full screen view or maximizing the window to 100%. I will now pass it off to one of our firm principals, Nicholas Anastasakis, for a brief overview of Cornerstone Asset Management.
Thank you, Stephanie. I appreciate that. And thank you, everybody, for joining us this afternoon. Just real briefly, if you're not familiar with Cornerstone, who we are, real brief, we are a registered investment advisor, boutique third-party manager located just outside of Cleveland, Ohio. We got started back in the business in 2005. Started managing actual client accounts here in 2006. Most of our key strategies have actual history since 2008, not hypothetical results or anything like that. Everything is fully back tested. All of our extensive research and all of that kind of stuff is daily monitored, market activities and all of that kind of things. We monitor approximately 140 different models, tested and back tested through typically several market cycles. We analyze those daily. It's literally thousands of ticker symbols that we monitor for trends and keep track of. Our focus has always been on tactical strategies. Our bread and butter type things are all asset classes, go anywhere type funds. We have expanded our platform to include several passive strategies, individual stock strategies, dividend portfolios, tactical fixed income, and even mutual fund and variable annuities, as well as like 401k management. So what we do, in a very general sense, Cornerstone provides a platform for RIAs and independent financial advisors to have access to a wide variety of investment options to satisfy their client investment needs in order to grow assets through prudent management, allowing the advisor to really focus on client relationship building and financial planning. Today's topic, is why market research matters. I'm going to introduce Ken Reinhart. Ken is our Director of Market Research. Just a note for everybody, Ken is very excitable, maybe I could say, or is very passionate about markets and economics, and so he does tend to wander, so it is part of my job today to kind of keep him on track. So with that, Ken, if you'd like to begin with our topic today, why market research matters.
Thank you, Nick. The zoo animal is in the cage. We can all be comfortable here. So I would like to thank you for your attendance as well. Our time is precious, so I hope to make this worth your while in terms of the time that you spend. What I'd like to do is, if I want to talk about what the markets look like going forward, or potentially look like going forward, we need to have a good sound understanding of where we are currently. And equally important, we need to understand how we arrived to this point. So with that, we talk about history. I'd like to go back to about 08, 09. That time frame was coined the Great Recession. At the time, Ben Bernanke's Federal Reserve took historic aggressive monetary policy actions to stem cascading asset prices. There was a tremendous fear that we were embarking on a deflationary downward spiral that frankly would have collapsed the economic system. Two acronyms came from this, well-known acronyms, even in the general public, GERP, that stood for zero interest rate policy. At the time, zero interest rates from the Federal Reserve was unthinkable. Just speaks to the level of aggressive actions that Bernanke's Federal Reserve took and other central banks around the globe. In addition to that, we had QE, quantitative easing, which was basically money printing. It was creating money to purchase various bonds, treasuries, mortgage-backed securities, et cetera, to shore up those markets. And through that process, it was extreme money printing in a sense from a historic perspective. The balance sheet of the Federal Reserve grew from $800 billion to $4.5 trillion in about 6 years. It is unheard of. For perspective, since the inception of the Federal Reserve, 1914 to 2008, it took that long to get to an $800 billion balance sheet. And it was in the mid-90s that it was about $400 billion, okay, to get perspective here. And we thought the mid-90s to mid-2000s was radical creation of money via the expansion of the balance sheet from the Federal Reserve. But what took place post-08-09, the Great Recession, dwarfed everything prior. Again, out of Bernanke and Cruz adamancy to stem a concern of a downward deflationary spiral. So what came of this was, in a word, is reflation, using extreme monetary policies to reflate the system. The objective, frankly, several. One was to reinflate asset prices, called asset price inflation. With the asset price inflation, the objective was to reestablish confidence among the citizenry at large, general market participants, and then importantly the business community. Confidence is essential, and the reflating process would, and turned out did, add confidence. This also altered societal behaviors, and that was as intended. ZIRP and QE, realizing that the human species is basically an incentive responding machine. Think of it that way if we get outside of ourselves. ZIRP and QE certainly provided incentive for what's called a reach for yield by the general citizenry. And that is where we've all been there in the last several years. You walk to your local bank and you see hanging on the board savings rates 0.25%, 0%, 0.5% at most. Conversely, you want to take a loan out, very low rates. What had happened through the process is this battle cry evolved. I've heard it many times. I'm sure you have. You may have even said it yourself. Where else am I going to put my money, right? So inferring that, what am I going to do with 0% interest? With that, the everyday citizen reached further and further out on the risk spectrum. Personal balance sheets now, as a result of this, the ultra-low interest rates, incentivize taking on debt, more debt, discouraged savings. As a result, the personal balance sheets of the everyday citizen is more at risk with higher debt levels, less savings. The savings that are on the books, so to speak, are further and further out on the risk spectrum, high-yield bonds, stocks, etc. Simultaneously to this, the reflation process where asset prices were pumped up, we had general economic growth and wage growth rates that were subpar. In particular, when you compared them to the rates of growth, the growth rates of asset prices. So with the follow-on, we had a societal distortion of wealth, particularly in the middle class, where more were going to the upper middle or lower middle relative to their exposure to the asset price inflation. Now, the current day upside following the labor market, we continue to see a tighter and tighter labor market through the laws of supply and demand that suggest higher prices, which in this case would be wage rates. So what we need to see here is we have undeniably, okay, we have very expensive asset markets. We need to see consistent, strong economic growth, and thereby feeding wage rate growth rates to a point where they can catch up, if you will, to the inflated asset prices via the reflation policies already mentioned. Currently, the reflation process achieved the objectives, if you will. The problem is the ZIRP and the QE and the reach for yield process have asset prices, stocks, housing, raw land, etc., at levels that either rival or exceed 2000 and 2008. Now, importantly, and I have to emphasize this, highly valued markets through the lens of history do not equal guaranteed problems. Okay? Valuation measures in analytics, tactical asset management, etc., are known to be very poor in their timing. That's the few times we have written about this, we always emphasize that. It all comes down to this. It's collective market participants. The markets are always forward-looking vehicles. They're looking out into the future and discounting what they see. They care about the future. They don't care about yesterday. Through this process, market participants can bid up asset prices to what seems to be extremely overvalued through the lens of history. And what they are suggesting is that they are expecting explosive economic and follow-on earnings growth for companies. Earnings growth is the lifeblood of company valuations. The more you make, the more you're worth typically speaking, in valuing companies. So the problem is if expected growth materializes, markets can carry on, even at extremely high historical valuation levels. Cannot emphasize that enough. The problem begins, though, is when expected growth fails to materialize. That is when you can see notable downdrafts, such as 2000 and 2008. Now, in those times, there was high expectations of continued growth, and it didn't materialize. Collective investors readjusted their assessments via much lower prices, and there you are. You're down 20, 30, 40%. So the concern, current day, is if these growth expectations don't materialize and we don't see follow-on earnings growth rates continuing to improve, that the everyday citizen, the everyday investor out there is going to be caught off guard yet again. That is our biggest concern because as we're seeing it, the everyday person is completely enamored with the stock market. We see it everyday, anecdotal evidence, general conversations that have nothing to do, I've ran into it numerous times myself, that have nothing to do with market analytics or anything. And then more formally, sentiment indicators in markets, we're seeing it everywhere. Said simply, we really love our stock market. So let's go into some visuals here. What I want to do is just take this narrative, give you some visuals of the sense of what's been taking place. This here is the monetary base. It's most correlated with when the Fed expands their balance sheet. It correlates mostly with the monetary base, which is known as base money. It speaks for itself. We're not going to spend a lot of time here. We've got a bump from $800 billion to $4.5 trillion. You see how quickly it rose. And then this is a bit, again, the mid-90s here, so that dates back to where I was talking earlier, where it went from $400 billion to $800 billion, and then an explosion in the Great Recession coming out of there. Next slide. Speaking to the disconnect between asset price growth rates in the last several years relative to economic growth rates and wage growth rates. These are two charts. On the left side is the number of hours taken, the average hourly earnings level, the number of hours it takes to purchase the S&P 500. This dates back to the mid-60s. So there's multi-decade view here, and this speaks for itself. And you cannot exaggerate or overstate how off-the-charts expensive this is. We have blown through the prior peak of the late 90s. On the right side is doing the same with the median sales price of new homes sold. This also speaks for itself. In this case, we have made it up to the previous high points of the infamous time frame in the housing market, that is, of the mid-2000s. So the asset price inflation has definitely taken place without follow-on wage growth rates that would typically speak to such an explosive move in general asset prices. Again, going back to the reflation policies already discussed. The next chart will speak to taking the actual economy. Now, this goes back to the mid-1920s, so there's a lot of history here. This is taking the market capitalization, just basically take the value of the stock market, and you put it as a percent of the economic activity, GDP. And again, we see here currently the far right of the chart has exceeded prior levels, only exceeded by late 1999. So as asset prices relative not only to wage rates, but also relative to economic activity, we have seen them eclipse it. Importantly, this can go much higher. There's no hard, fast rule that says X percent equals problems. Go to the next chart, which is, as I was discussing earlier, and this is the personal savings rate. It speaks for itself too, as I was saying, the personal balance sheets are more at risk. We have seen and discouraged savings via 0% interest rates, etc. We have seen this now rival the lows of the mid-2000s, which at that time was a significant concern. Next slide. Focusing on the personal balance sheet still, the lower pane of this chart with the red arrows. This is taking the average total consumer credit as a percentage of their personal income, their disposable personal income. That's their personal income after taxes are accounted for. A new high. We thought this was an extreme rating back in, again, leading into the Great Recession era of 2008, and we have completely eclipsed that. So all told here, bringing this back full circle, we've achieved reflation on the back of historic monetary actions. We need to see economic growth rates begin to follow on consistently, where we can see wage growth rates improve and pick up and pick up. Because at this point, the individual's personal balance sheet is more at risk relative to the concern on the savings rate front, the concern on the debt rate front, and then in light of the lack of savings that are attained via the reach for yield has pushed them further out on the risk spectrum. So the balance sheet overall of your everyday person is more at risk. Now, if we go to the next chart here, this is admittedly what do I want to call this, a daunting chart perhaps. We're going to keep it really simple. This goes back nearly 100 years. Focus on that black line. That's the S&P 500 through nearly 100 years of data. Now, the squiggly lines all over, we got red, blue, and green. This is what the S&P over time is trading at on what's called a price-to-earnings ratio. That's just the basics of PE. It's very simple. You take the price divided by earnings, you get a ratio. Keep it very simple. If you're a company that makes $1 a share and you sell your company for $20 and you make $1 consistently, you don't lose or grow at all, you make $1 consistently, the purchaser would take 20 years to get their money back. Now, obviously, the idea is if you're purchasing a company, it's for it to grow. And there's an ebb and flow, as we know. Sometimes you grow, sometimes you pull back, et cetera, et cetera. As stated via the reflation policies, there are times where collective market participants are seeing something out in the future, or they think they see, that doesn't materialize, and then you get these adjustments. Over time, though, we see the S&P going higher and higher, but not without significant drawdowns. So let's go. We're going to drill into this chart. We're going to explain this a little more. Again, I want to take it to, now we're going to zero into the late 80 time frame, mid 80s or so. I have a black and a red arrow in the early 90s, and then one more current day starting around 2015 area. This is the only time I could find in this near 100-year relationship of this chart where the S&P, the black line, trended higher and higher, while in this case we're going to focus on the squiggly red line, which is a historically expensive market is what that means. That's a PE of 20. That's where in the early 90s we've seen the red line trending down as the stock market black line was trending higher. With this, the market was clearly, we can say this in hindsight now, was clearly seeing something explosive out there in the future. And we all know what that is, the internet age, right? The whole new age. The only time we have seen in this 100 years of the previous chart outside of our recent experience is right here in the early 90s. So if we go over here to the far right now, we also see in the last couple of years where the red line was trending down. And what this tells us is that earnings were actually going down. You had a deceleration in earnings growth. That's not good. Historically, that's a bad omen for stocks. But the stock market held in there and then proceeded to move higher and higher. The question has been, what is the market seeing? Okay, and is it going to be accurate? Now we've seen the red line moving higher, pointing to actual earnings growth picking up in the last few quarters. At this stage, we can say, hey, the market was right. What it was seeing was true. It showed up. But what is important about this is now we got to look at the relationship. The black line, that being the S&P 500, as you can see here, is still very far extended above the red line of a PE of 20. The problem with this is historically, you don't stay above there for very long before you have some problems. This is where, again, taking us back to the early 90s, this is where we need to see the earnings growth rates pick up dramatically along with the economic growth rates, where we can see the earnings come in to support these elevated stock prices and other prices as well. As I said, housing, raw land, etc. If it occurs, like we've seen in the early 90s, we could see earnings growth rates grow so fast that the S&P 500 itself would reestablish its relationship with that red line and go below it. Nick, can you point to that, the early 90s there, about 94? This right there is where earnings started to grow so fast while stock prices held in, and they continued to move up slightly, and then they got in line, so to speak, from a valuation perspective historically, and earnings continued to grow and stock prices went ballistic to the upside. As we all know, we lived that. So here, current day, the question is, does the stock market see some new economic environment coming? We're not going to get into, we could spend a couple of hours digging into the potentials and the downside potentials. We just want to focus on this big picture, 100,000-foot view through the lens of history, that markets are undeniably expensive via historical relationships, and establish that concretely. We have done that via the various measures we've looked at. Importantly, though, it does not mean that we have to have a guaranteed problem or big correction or drawdowns in asset prices. What it does mean, though, is we absolutely have to see consistent economic growth going forward that will give wage rates consistent growth as well to catch up with these asset prices, if you want to say it that way. The next slide shows back to the hours worked to purchase the S&P 500. I want to do a little toggling here. This fascinates me. I'm in my mid-50s, 53 years old. I've lived through these experiences. I have a lot to draw on. I was I was in high school in the early 80s and lived through the 80s, et cetera. I have a sense of the not just the economic backdrop, but the societal backdrop. Also, the previous chart, the PE chart, is a chart that I've carried around with me, so to speak, and spoke to audiences for almost 20 years. So I've been watching this process as we've reflated and deflated and reflated and deflated through the lens of these valuation measures. Nick, could you go to the previous chart on the PE and point down here to the early 90s? So in the early 90 time frame, as we established, we know via the black line being so much higher than the red line that the stock market was very expensive from a valuation perspective. Go to the next slide. We're gonna do a little toggling here, and this is where I may be the zoo animal left the cage, guys. In the early 90s, the hours worked relative to now, or said another way, hours worked now relative to back then. I can't find the words to even use here. I mean, extreme doesn't seem to fit. So as it took 35 hours of work to purchase the S&P back then, speaking to the level of earnings relative to markets, they were, shall I say, normal. That's a subjective word, but they were reasonable, normal, etc. Whereas now, let's go back to the previous chart again, Nick. Whereas now on the far right side, we see the S&P, as we know, the black line is far above the red line, denoting far above a PE of 20, and historically that's very expensive. Then we come back to the other chart, and we look at the hours worked, current day, and we see the massive disconnect. So if I do nothing here today that can leave you with something that sticks in your mind, is please realize that these markets are undeniably expensive. Historically, through the lens of history, through various metrics and measures, they are expensive. But that does not guarantee problems. Okay, so I hear a lot that, there's, I call like apologists, if you will, for the markets. So, they want to say, well, they're not expensive. And for whatever metric you can pull out of the, off the table and point to. My opinion is let's just let the data speak for itself through the lens of history. And let's just acknowledge the fact that they are expensive. And at the same time, the other side of that coin, there's a lot of analysts that talk about expensive markets and insinuate there's no way but going down. I disagree. And again, through the lens of history, we're letting history guide us. The early 90s told us, it showed us that we can have historically highly valued asset prices. And that can be a way for collective market participants to say, it's no problem. We are really excited about this asset class because we see explosive growth coming. Okay, the next chart.
Ken, let's pause here for 1 second. I had a question come in, and the person on says, We'd like to know if Ken really thinks earnings can grow that quickly, or if it's more likely that we go sideways until earnings catch up to normal, kind of that organic earnings growth like we looked at on the previous chart. Excellent question.
There's so many. I would love to go into all the variables that we. That's a variable that we could be looking at. Sure. The markets go sideways in some form, maybe a 5%, 10% range, something like that. They go up or they go down, but they stay in a general range while earnings continue to improve. In fact, we've seen some of that in the early 90s, about 93, 94, where earnings kept going higher and higher, and the markets took about 9 months off or so there. Well, in market land, that's an eternity. So that can certainly happen. We also could see, you never know. The thing about collective psychology is you don't know how lathered up it can get. For my part, if I could write the script to collective market participants, I would beg that we just mellow out some. Runaway asset prices that lead to asset bubbles, in the long term does no one any good. They just lead to implosions, ultimately destroy cytology. We've been through it a couple of times, 2000, 2008, more recently. But that certainly, as per the question, is certainly a possibility. I just have to hold out, like the sentiment indicator, for example, investors' intelligence. We now are at the highest level since early '87. Okay, now, and it's relentless. It just isn't coming off. I mean, usually in the last 10, 15 years, we'd get to these levels or actually below it, and we would see them come down and mellow out. Something would happen, maybe the stock market would go down a few percent, whatever, and we just go higher and higher and higher. And it begs the question, at least in my mind, are we about to do some runaway freight train, so to speak? I hope not. I hope not for everyone, even though that would be very exciting, and investors and participants and 401k people would be looking at their statements. My concern is X months down the road, they may be really disappointed. So there are variables, and the way this unfolds, I'd like to add this right here on that point. We do a weekly view that we send out. It's a free weekly view. If you're not on, you can connect with research at Cornerstone Asset MGMT.com and just request to be on the weekly view. What we do is we try to share, because we are hypervigilant, frankly. We are very open-minded that these markets could go considerably higher or a lot lower. Okay? And so what we do in the weekly view is we have a long list of data sets that we follow. We share a little snippet here and there from the perspective of, hey, this is kind of getting concerning here. In fact, the sentiment, we did the sentiment piece. Margin debt last week, the week before that, we did a sentiment piece. Just speaking to the point that we are really in love with the stock market. So you might want to consider following that as we go through time, the idea being that we share, like I said, we share points of interest. As we're going through this, it's a storyline. Frankly, we don't know where it's going. I think anybody that tells you they do is either fooling themselves or maybe lying to you. I don't know. But I say open mind is the operative phrase, is the operative perspective here. So going to the next chart, Nick. This here, okay, this is really catching my eye. Capital investment is a linchpin for real economic growth, real prosperity. Very simple. Just what is it? The amount spent to acquire productive assets, such as buildings, machinery, equipment, more specifically excavators, forklifts. You get the point. It's to increase productive capacity or efficiency of a firm. The idea here, economically speaking, it's a glorious process, okay? This capital equipment is purchased, ordered. The economic activity is increased via the building or build out of the capital equipment, the transportation of the capital equipment, the deployment of the capital equipment. And it doesn't end there. The follow-on benefits just begin. Now you get all of the productivity enhancements for months to years to come, where you'll see the individual worker be more productive with the enhancement of capital equipment. And with that, for the company, unit labor costs, the amount of labor paid per unit of output, goes down. Hence, their productivity is higher. And with that said, they can afford to pay higher wages and still be profitable and still grow their earnings profitably. So everybody is happy, so to speak. What we have seen, if you notice in the early 90s, this chart was going straight up. It was excellent capital equipment investment. And then we went down with the recession, typical. Where it gets interesting is in leading into the 08 timeframe, we just hit a ceiling. We couldn't make a new high. And then drew down, and yet again, post-Great Recession, we just went sideways at the peak. And then started trending down. In the weekly views I mentioned, we have addressed this a couple of times, the fact that it had been trending down until the last year, somewhere in there. This uptrend Nick just drew a red line on to the far right really has my attention. Go to the next chart, Nick. Coupled with this, it's the same thing, capital investment. But this is looking at the same thing we just looked at, but it's the year-over-year percent change. And I want to get you to look at the post-Great Recession, okay, the 2009 period there. So we had this was negative, and then it went positive. But in the 2010 through 2012, the percentage growth rates were strong, 10, 15%, but hit a wall and went down, and then just hovered around the zero line for years. And then we were negative. Again, in 15 and all, why we were so concerned about where is this economy going here, and because we had historically highly valued markets. Knowing full well if the economy was going to turn down, there's no way that you're going to see recessions are the death knell for especially expensive asset prices, as we've seen in 08 and in 2000. But now we're seeing this, the last few months here, the growth rates have just sat me back in my chair, frankly. I keep saying to myself, something is going on here, okay, and it's positive. Whether we look at this chart here with the growth rates or go to the previous chart, Nick, and we look at the absolute dollar amount, it speaks to the same thing. And that is a tremendous improvement. At this stage, what we're watching for, and this will take months, this doesn't change in a week or a month, is can we get to a new high, both in the percentage growth rate that we're looking at right there, as well as the absolute dollar amount. Can we get to a new high? And if so, at that point, it's going to be undeniable that we have a true personality change in our economic structure from what we have seen for some time. Now, the importance of this, as stated, this is one of the linchpins of creating real wealth, real prosperity throughout the economic structure. This is why I watch it so closely. It's a personal favorite of mine as well. Having been in various industries, exposed to various industries that deploy capital investment, and seeing it firsthand, and seeing the improvements across the board, it's like I said, it's in economic circles, it's a glorious process. So the next chart, what's the next chart, Nick?
Next chart's where we dive into.
Okay, we're going to go into the dividend income.
Yeah, the details, right.
So here's what I want to do. We're going to do this in about 60 seconds max. Nick, take it back up to the monetary base. We're just going to, so basically we narrated, how we got where we are here and where we may be going. So the monetary base, as you know, massive expansion in the monetary base leads to the reflation objective, leads to asset prices achieving the objective. Growth rates of those asset prices go up and up and up and up and up, far exceeding what we've seen in economic growth as well as wage rate growth rates. At the same time, with the QE and the ZIRP, we've seen disincentivized savings rates. The savings rates followed suit. Debt was incentivized. Lower pain of that chart there, new high. When we thought the mid-07 time frame was already unbelievably high, we've blown right through it. Next chart takes us to the valuation level, the black line being the S&P. And we see, if you can do this, looking at this in its wholeness, if you will. You see historically how the S&P 500 would toggle between these lines, the expensive red line, the cheap green line. It would just go up and down and toggle around. Again, this is decades worth of data. But interestingly, via these reflation, deflation, reflation policies that we've been going through in the last 30 years, the 87 crash, post-87 is when we really kicked into gear, and it's just gotten, each reflation policy initiative has gotten more extreme, fearful of deflation. So we notice how we tend to live, so to speak, either above the red line or just below it. And then we dive lower, okay? Emphasizing the point that we have to see economic growth come on here. The next chart drills down to, as we discussed, looking at the precedent here, that we may have a situation where earnings like the early 90s, earnings and growth rates for the economy may be picking up as collective market participants seem to be suggesting. And then, of course, the hours worked, we've discussed how the the growth rates of asset prices have far exceeded the growth rates of wages. And then here's our hope, if you will, in capital investment. So this is what we're following, as well as many other measures, of course, but if capital investment can continue to trend, it will be a tremendous positive. And at this point, we're just keeping the watch. So with this said, this is the 100,000-foot view, so to speak. Nick is going to drill into one of Cornerstone has a plethora of portfolio offerings. He's going to drill down into the portfolio via dividend income portfolio. So go ahead, Nick.
Thanks, Ken. So yeah, like Ken said, he's operating, the economic views at 100,000-foot level. I'm going to take us down into, all the way down into the weeds, so to speak, specific portfolio and how we create, how we have an actionable portfolio idea from some of that high-level economic research. We're going to focus specifically on the dividend income portfolio. This is our long-only dividend yielding portfolio, individual dividend-paying stocks, high-quality, high-conviction names on the individual stocks. Fully invested, we're holding in that portfolio roughly 19 stocks. Ken has used this word a couple of times already, just vigilance. So this sort of economic view provides us with the need to be vigilant on all of the individual holdings. We monitor everything that we hold on a daily basis. And what we do in the dividend income portfolio is we call it pruning. Prune the tree if we need to. And we're going to talk about a very specific stock today when we click to the next slide. It is specific, but it's also not. There's so many instances of slides that look or charts that look like this today. And what strikes me as Ken was talking here, everybody kind of says, we're in this raging bull market. Everything's just going up. You could throw a dart and find something that's going up. Well, that's not entirely true, and it speaks to me to the fragmentation of the market that we're in. So this is an example of portfolio pruning, how we manage an individual holding via the dividend income. So inside of dividend income, we held General Electric, GE, paid a nice dividend in the portfolio, real nice and all of that. What we had to do was prune this out of the portfolio. We sold it 11/3/16. I'm going to draw an arrow to where we sold it, and it was right around in this level right here. We sold it at 28.30 on that day. What was happening at this time is as we monitored this under this sort of high vigilance time frame, under this high vigilance watch, the stock price was deteriorating. It was cutting through several of the moving averages that we monitor. And so our caution, the caution flag sort of goes up. And at this time, we decided that we wanted to sell GE from the portfolio, and so we sold it out of everybody's account. We were basically within $3 of the high. You can obviously see that after we sold it, it went and retested this high just above $31. So we were sold within about $3 of the high on that stock, which we would say is good. But look at the picture that's happened since that point. Essentially, we sold here at about 28.30. As of yesterday's close, we went and touched, it was actually sub 18. It was below $18 a share yesterday. That's roughly an additional 33% loss that portfolio would have taken on if we had continued to hold GE. So it just kind of speaks to, again, to that fragmentation or deterioration on the individual stock level that we can't allow to happen on any holding in any of our portfolios. Now, the question obviously becomes, is that an isolated case? And the answer is no. We've had to prune out, I call it quote-unquote ugly charts like this 10 times in the past 12 months or so to take it out. So we took that 19 holdings down to roughly 9 via this pruning process. We've added 2, and we bought one of the old ones back. So I think as we sit today, I think we're roughly at 10, 11, maybe 12 holdings out of the 19 that we currently have on in the portfolio. Now, what's real interesting is all the news that hit on General Electric just this week. I don't know if you saw the news, but on Monday, General Electric came out and they had to slash their dividend 50%. Here we see a handful of headlines on GE specifically here this week that, you know, even the rest of the dividend may not be safe even after that 50% cut. You know, expectations of more bad news. It was a loss of over 10% here already this week. Now, it did find some footing down there and was up about 2%, I think, here today. But that kind of ugly picture really speaks to, you know, what we don't want in our portfolio. And that's the kind of pruning or the individual position management that we have to monitor in all of our portfolios. Real quickly, the Alpha Beta platform, you know, the research and portfolio mechanics that we talked about today are what happens on all of our quote-unquote in-house portfolios, the dividend income, the Cornerstone portfolio, foundation, managed bond, etc. But the Alpha Beta platform consists of all of those portfolios in-house as well as our outsourced portfolios, such as that calendar effects portfolio that I'm sure some of you are familiar with. That portfolio is very different than anything that we do. It's complementary to all of our things. It's tactical, but in only around calendar predefined sort of dates and stuff like that. So kind of a neat complementary sort of a piece. Up next, guys, just keep a lookout for the next installment. It's going to be in February, so after the holidays, we're going to do sort of a manager focus or portfolio spotlight on a specific portfolio that's available on that Alpha Beta platform. I think at this time, Stephanie will open it up for any questions. Did we receive any questions that we did not answer throughout the presentation here?
Yes, I did receive a few. And again, if you want to unmute everyone, you can go ahead and ask any questions at this time. But I did receive one. How often is dividend income fully invested?
How often is it fully invested?
Yes.
It's obviously intended to be fully invested at all times. However, when we're monitoring those individual securities like that GE chart that I just showed you, it sort of organically walks away from being fully invested. So we do intend for it to be fully invested at all times. But you know, as things deteriorate, as markets fragment, we need to sort of be more proactive with those things.
And another one here about dividend income. What is the lag time typically for monies that come in for it to be fully invested?
Good question, and that can be a significant time. Obviously, we do provide investors and advisors the ability to sort of, you know, kind of go all in if they wish. That's probably not our intent. Our intent would be to watch for, I kind of call them smart entries. Entries where we're good or where we're comfortable with the entry price being a long-term holding in the portfolio. Like I said, we obviously want to be fully invested and hold these names for a significant amount of time. So it could be sometimes that's a quarter, sometimes that's 6 months, 9 months before, you know, everything would be fully invested. And that sort of fits with the rest of our portfolios as well.
Okay, and I do have one more which kind of relates to that. What is the average holding period for stock and dividend income?
Like I kind of said or alluded to, we do anticipate those holdings to be longer term. Mark Suhays, the gentleman who manages specific names and does the fundamental work, the analysis around the specific names in the portfolio, he and I sort of refer to them as we intend to hold them for a year or longer typically, which is much different than some of our trend following or more trading sort of following other portfolios.
That's all I have on my end. Were there any other questions from participants?
Nick, this is Ed McManus.
Hey, Ed.
How you doing?
Good.
Good. If the market starts to tumble, what would be your procedure as far as the dividend income fund?
Well, the procedure around dividend income would be more or less the same like we already kind of highlighted, and it would be sort of at the individual security level, monitoring each individual stock for the specific breakdowns.
Okay.
We don't really put around hard and fast stop losses on things. We monitor several different moving averages and indicators on a shorter term basis. And it would be sort of on the individual holding level. We could take a snapshot today of those 12 names that are in, and a lot of those charts are very, very different than that GE chart, obviously. GE has to go, and so the ones that look nice, they stay. So the pruning process on market taking a dive would be, again, at the individual holding level, managing those names that way.
All right. So if they cross that line, wherever you determine that line is, you could and would sell out of all of them.
Yeah, we could. I think it would be pretty unlikely that in that dividend income portfolio we would be 100% cash.
Mm-hmm.
All of our other fully tactical portfolios, those are more likely to go 100% cash or even short where it's appropriate.
Okay.
Dividend income would probably, I don't want to say never, but I think it would be pretty unlikely that it would go 100% out.
Okay, thanks.
Mm-hmm.
Any other questions from participants?
Hey guys, I appreciate everybody staying on today. We did go a little bit longer than we intended, so thank you very much for doing that. Thanks for coming on. Watch for the invites for the one in February. We'll have a portfolio spotlight on the next one. If you're on the social medias, make sure you follow us on Twitter, Facebook, LinkedIn, wherever. Email one of us if you're not getting the weekly views like Ken mentioned. Email one of us and we'll be happy to put you on. And thank you again for the attendance today.
Thank you.